future by someone else. There won't be that many new candidates leaving the universities and educational institutions. So basically, the industry needs to take care of this themselves. They need to educate, take in resources, take in young people that might not have the completely relevant education, and basically develop them into the roles, which is also what many of our largest clients do. So they basically face the same challenge and basically take the same approach to it, that internal education and buying external education, using consultants to basically train your own resources and such is an important part of moving IT operation forward. Whether it's outsourced, as we're talking about today, the outsourcing market, or whether it's insourced, it's something that you do yourself. Okay, and then we plot spoil your presentation by saying, yes, the unit prices continued to fall in 2022. Not as much as the years before, but they did fall. And we are facing some uncertainty regarding the price development here in 2023 and beyond. So that is the reality right now. We are a bit cautious in giving strong guidance as to where we believe the prices will end, though we do have, and we will share with you today, we do have some ideas as to where most possibly will end up.
Yeah, and you can say there's factors pulling in both directions, right? You have the continuing technology developments and all these things that pulling in one direction, and then you have inflation and other parts pulling in the other one. But I'm sure we have some more.
Yeah, we'll get into to the. Yeah, also we have a specific article on that in the previous number of quarterly, where we actually go through this. I'll just give you the headlines in a while. And then, okay, the list here is the sequence on these two slides. Also, basically, it gives you an idea of the priority here. Security services is the single area where we've seen the highest increase in demand. So there's a huge increase in demand for security services of all kinds. And this both plays into the security built into the traditional server storage, network operational services, but it also points to specific isolated security services. We published a report specifically on those security services. So for those of you who want to go further into detail on that, we do have a specific report. I even think, I'm not sure whether we did a webcast on that, but we definitely do have a quite extensive report on the security services in highest demand in the market right now. Okay, so page 2. The growth in public cloud capacity was lower than expected. So but still a growth. So that brings us to an important trend that continued from last year. That is that the hybrid offerings, the clients are going hybrid. Almost all our clients are now in a situation with a mix of classic outsourcing or on-prem capacity and hyperscaler capacity. And what we see is that the vendors, of course, need to address that need in the market with what we call hybrid offerings. And we saw those offerings mature during 2022. But there's still a lot of room for development and improvement in that area. One of the big things the market is still struggling with, we are actually not right now in the middle of several negotiations between clients and vendors on these on these hybrid offerings. And one of the big issues here is really how do you incentivize the vendor to help you optimize the capacity in the cloud. So the problem here is you and the vendor has a shared interest in that you do not spend more money in Azure, AWS or Google more than you need to do. But if your payment scheme for the vendor is based on the number of VMs, then their incentive to help you optimize is not there. So that is what we see in a lot of the pricing models, is that it's basically P times Q models, which gives the wrong incentive. So we are seeing now hybrid offerings with other pricing models than the pure P times Q, and pointing in the direction where you actually at least do not have a negative incentive for the vendor to help you optimize, and some of them even with a positive incentive. But that is why we're saying there's still room for development. So the contracts that we see entered right now, a lot of them still on a P times Q basis, and therefore not in our not where we believe that market will end up if the services are to be good for the clients.
I believe one of the interesting analogies that we sometimes use is that you don't want to feel like you're taking a cab in an unknown city where you don't know the route, because then you know if the driver might take a different route and all these things. So that's why you need to employ some road safety tips and know your destination and check out the route and where you're going. Yeah. So that's why we see the increased focus on FinOps.
Exactly. So clients, whether they have outsourced the cloud management or whether they do it themselves, they are focusing more and more on FinOps because they basically need to have a control of that. That's true. ESG, a new abbreviation we have to learn the last 2 years. Environmental, social, and governance, right? I think, yeah, I think that's right. We need Dan here, our ESG, our resident ESG expert. ESG basically means, in this case, means that a focus on carbon emission from your data center operation. New EU legislation is being put in place in 2024, meaning that a number of you sitting here will have to report or at least make sure that your contracts has regulation in place for carbon emission and greenhouse gas emission reporting and so on. It's getting higher and higher on the agenda, but it's still very immature. And basically you could say that it's, when you look at the legislation here, it basically says, yeah, you need to have some kind of plan for the reduction of the emission in your major contracts. Some of you will need to have those kind of instruments in your agreements. Now, the interesting thing here is, of course, how you measure it, but it's also how you set targets. Because just putting into the contracts, we need to reduce the emission. Well, that basically favors those with the highest emission because for them it will be easiest to lower the emission. So what part of the community is moving towards is actually to set absolute targets. So where should you be? What is actually the ideal emission for a capacity this size? Completely immature area. We believe we follow and assist a number of clients in this area. We believe this is an area that's going to mature significantly over the next years. And both clients and many of the vendors are quite, what you could say, seeking in this area, seeking ways to basically do this. And then not a big surprise that many vendors taking their software from classical software to SaaS solution is removing capacity from the ITO market. Now, as you saw before, that doesn't necessarily mean that the ITO market will shrink, because and that's the last bullet, we see new developments in mega trend areas like analytics, AI, machine learning, and IoT drives substantial increase in capacity demand. And I believe that the last one is perhaps the most important one when you look at the overall development of this market. Because there might be people believing that cloud and SaaS will be the death of the ITO market as we know it. Because that would be the logical conclusion to say, okay, a lot of capacity will move to hyperscalers and a lot of capacity will simply disappear from traditional ITO market because the client is taking their Microsoft or SaaS or SAP solution and buy it as a SaaS solution. But what we see is that there's a number of other areas that will drive significant load, at least for the foreseeable future. So as with the mainframe that was doomed dead many years ago, today we see fewer mainframes but more MIPS installed. We believe that for the foreseeable future there might be fewer organizations with in-house IT operation. There might be fewer IT vendors, ITO vendors with a big asset base. That could be that could be. We're not saying it's going to be the trend, but that could be the trend. But we don't believe that the number of VMs provided in the market will go down. We do not believe that the number of gigabytes of storage will go down. On the contrary. Because if you look, and we've helped a number of clients prognostize based on just these mega trends, what we are seeing there is a very sharp increase in both storage and server capacity within those clients, driven by analytics being democratized. So more and more people in the organization get access to these quite CPU demanding tools. We see AI and machine learning driving a lot of also internal capacity together with IoT, including cameras and stuff like that. Okay. This was the one you talked about earlier. Perhaps you will go through what really drives the price.
Yes. Well, the headline here is that there are still opposite forces impacting cost and unit prices over the coming years, and the factors driving costs up, and then the driving factors driving us down. And if we look at the storage indexes, it has been falling quite sharply in the past many years, but it has been slowing down a little bit. And one of the reasons for this is, of course, the labor shortage and increased wages, and it's also what you mentioned before with the highest, most, what was it, the biggest challenge for.
That is, and labor shortage is driving wages up right now.
Yeah. And then, of course, you have inflation in general, and increased energy prices will, of course, have a large effect on the just having the hardware running. But all of these kind of have an opposite effect as well. So while you have increased inflation and you have higher energy prices, you also have technological advancements, and where you can push more hardware into more capacity into the same hardware, and you can say that they get more efficient with the energy. So while energy prices may go up, you also have more efficient hardware, and then it kind of equals out. And exactly where it ends up, that's hard to say, right? Because people, of course, ask us, will the prices increase? And we do think that that's unlikely right now.
Exactly. Yeah, because, I mean, basically what we're looking at is all the down arrows. They've been there all the time.
Yeah.
That is basically strong forces that has driven down, and we'll get to the numbers in a short while. But since we started tracking this market, we have our indices starts in 2010. But you could basically go back to the 80s or 70s, I think.
I would like to see that graph.
Yeah. Well, I did one with saying that my first PC from the 80s and the PC I have today, they're roughly, actually the PC is cheaper, but it has 200,000 times the storage capacity than the one I had 30 years ago. So the things going down, driving us down, Moore's law, increased competition. No, increased competition, we'll take that in a while. But the automation and the energy efficiency and so on, that is driving costs down.
Yeah.
And then the second bullet is an interesting one. When you look into the actual profits of the different services, there are some areas that has been very profitable. For example, storage. So there's also room for competition. And as I started by saying, it is a quite competitive market. So we believe that what we are going into is also a year or two where we will shave off some of the profits in some of the higher profit areas. We could be wrong. There could be a cartel, but we don't think there is. So basically, we believe that that's going to happen. Now, the things driving it up, among those you mentioned here, some of them are new, right? So the situation now is different from the situation 7 years ago, 8 years ago, 10 years ago, because we do have a labor shortage and an inflation and energy prices that we didn't see before. And obviously 2022 was more extreme than ever, so it did have an impact. Now, we did some modeling because we had people asking us what's going to happen, and the only way a consultant can answer that is by saying, well, several things could happen. So let's do some scenario planning, and that's what we did here. It's basically we say, okay, so we have a number of things basically impacting the price that could happen on a one-time or a more continual basis. But so the baseline is basically how we would expect the price to develop over 4 years. That's the lowest blue line. And basically what we're saying is, okay, so 3 things could happen. Substantial increase in energy prices. A 100% increase that would stay there. So the energy prices going up, the energy pricing double and then stay there. That's number one. Number 2 is a one-time 10% increase in wages. And number 3 is a substantial increase in component prices, 20%, that will stay there. Right? It won't bounce back. So those are 3. They are possible, but they're not very likely. But they're possible. And what you can see is each of these 3 in isolation will have a negative impact in year 1, but it will basically level out in year 2, and you will look into a decrease over a 4-year period. It's only in the perfect storm of all these 3 things happening together. So substantial one-time increase in energy prices, and they stay there. Substantial increase in wages, and they basically stay there. In the normal one, there's the normal wage increase, and then there's the component price increase. Now, we believe it's unlikely that all 3 will happen in concert. So it might be a combination, but even a combination of any of the 2 will result in a decrease in prices, over a 4-year period. So that's just to say we find it quite unlikely that the prices over a longer period will increase.
Yeah.
So there might be bumps on the way, but it's unlikely on the long.
Yeah, and even if you just take the energy prices, while there have been some large fluctuations, they have pretty much leveled out, right?
Yeah. So that one basically we can basically take that out of the equation right now. Could come back, but we can basically take that out right now. So that is just to say this is a kind of a sensitivity analysis. We have a full article on it, of course, but that's a kind of sensitivity analysis that basically shows you no, we don't believe it, and put to that you have areas where the profit is quite high, and there's room for actually shaving off some of the profits in storage. Put that on. No, we don't believe the unit prices will show an increase over the coming years.
Yeah, and just yesterday we actually had responses to RFP and from different suppliers, and you can actually see that there are still suppliers who are factoring in long-term declines in the unit prices.
Yeah.
So, and that's
fresh numbers.
Yeah.
Straight out of the press. Yeah. That's good. Yeah. I didn't even have time to look at the numbers yet. So, but it is actually we are seeing.
Yes. Some of them have steady prices, but there are still suppliers with declining.
Good.
Yeah.
I think they're even on the call. Perhaps. We don't know. We don't know. Okay. Okay. Good. So, Adrian, the indices.
Yes. Well, this is the Sangberg index, which is the composite index containing server, storage, database, and workstation services in what we call the typical outsourced ITO contract. And if we look at this all the way back to 2010, there's been around 7.6 decline in the annual prices. And that's just to give you some historical context. And of course, a big part of this is the server operations, which have been declining by about 11% or 10.7%. And then we also have the storage operations, which have been declining by about 17 or 18% yearly since 2010. And all of these growth rates, when you look at them in since 2010, they have been quite high. And basically, it's kind of hard to see here, but
I think we put in here.
Yeah,
we are battling in the company. This is my graph. The previous one was Adrian's graphs.
Yeah, but actually, the reason that I made the other one is to say that if you look at it all the way down to the bottom right, the index looks like it has been flatlining.
Yeah,
but that's actually not the case, because maybe this graph is not the best way to see it, because the index has been going on for so long, it's hard to see the movements
exactly
in the end.
So this one, there is a decline in the decline. I mean, so the graph does. I mean, to some extent it does give the right picture, but it kind of exaggerates the picture.
Yeah, because if you look at this nice graph, you can see that if you actually go from year to year, I believe that is in the past 4 years, you still have these 8% declines in the server operations.
Yeah, and basically what this shows us is, I mean, I think that there are several interesting things. Now, it was wild bonanza then in 2014 to 15, where we saw like a 15% decline year over year. We're not there yet now. But we are in a place where we saw that the last 3 years, the prices declined 17%, which is still, I mean, if you have a big contract, that is a significant number. So basically, definitely something you need to make sure that you take your contract down to market price whenever you can. But it also shows that last year was a hard year, because we were at 4.7%. Now, people will ask us, So what about 2023? We don't know, is the good answer. But the previous one, the scenario planning, well, we don't expect it to drop 14.7%. I think that's fair to say.
Yeah.
So we don't expect it to drop a lot. Could it flatline? Could it be a 0%? Well, you did a graph. And though I love my own graphs, this is storage, similar picture, really, 25% over 3 years. Not flatlining, but though getting a little lower in the last one. I think you made this one, which I think is a good one.
Yeah, because in the large picture it has been slowing down, but if you zoom in and then look at just 2022, you can look at the quarterly growth rate. So just be aware that these are quarterly growth rates, not yearly. But even still, if you look at just 2022, you have the same picture where the growth rates have been declining at a slower pace than usual. But just from Q3 to Q4 in 2022, there's actually still been a decline of about 1% in both the server and the storage index. And you can say if you take that quarterly growth rate and just in that one and then annualize it, then 1% growth rate is about 4.1% annual. So
But I think perhaps just to preempt the question that might come, if you look at the storage though, you could say the decline keeps declining.
Yeah.
Right. So you could argue that minus 1.04% is not it. I mean, if you it could be smaller. We can't rule that out. The interesting thing though is that storage, as we said before, should be an area where competition should drive this in another direction. So let's see. We think it's extremely interesting to basically observe this market. And if there ever was a reason to buy quarterly analytics, it should be now to basically follow this, because we're moving into uncharted territory, and whether it's going one direction or the other, I wouldn't bet my newly bought car on that. I would basically say that's interesting. One thing about storage that we've noticed is that the competition in the areas of buying a lot of storage. I mean, if you are buying plus 1 petabyte of storage, right now the price is extremely high. I mean, the unit price for a gigabyte of storage, if you are buying like 50 terabytes of storage, is still, the outsourced alternative is still very competitive to doing it in-house. But if you're buying 2 petabytes, most vendors will offer you the 2 petabyte at the same unit price as the 50 terabytes. But producing 2 petabytes internally, in-house, is much cheaper, because basically when you get above 1 petabyte, the same people can basically handle the next petabyte and the next petabyte of storage. So basically for that excess capacity above 1 petabyte, you only need to pay for the hardware. So that really is an area where we expect more competition in the high capacity storage area. Whether that will drive down the prices across the board or give you a more differentiated storage price, well, time will show. And then basically we will have to track different kinds of storage prices. Interesting area. Storage is an interesting area also because the cloud alternative in some cases is extremely low cost, because you can buy very, very low cost storage for your cold storage, and that might be the alternative for many clients looking at the cloud alternative to archive and cold storage. So yeah. Okay. Public cloud. That's an area where we said before that a lot of the future is hybrid. the clients are moving some of their capacity to the cloud. We just had a webcast on Cloud FinOps, so for those of you who want to go into detail on that, please go to our YouTube channel. There's a very influential, we are YouTube influencers, as you know, so senior influencers. So you'll find there something where you can go into depth with the FinOps. And by the way, we will host a special cloud FinOps webcast in June. Stay tuned for that. That will take you into new heights of how to optimize in the cloud. We are working right now, Morten Chabanier-Schmidt here has been working for quite some time on some optimization, in some optimization areas with some of our big clients. And we will demonstrate there some of the levers there. But basically, in quarterly analytics, you can go in every quarter and you can see 5 archetypes of configurations. And basically what we demonstrate, I don't know, do you want to take us through?
Well, yeah, I can give it a shot. Basically what we publish are these 5 archetype setups, which are just different combinations of server, storage, and network traffic, and cloud management, and so on. And then we compare them with the on-premise alternative of the same setup. And we go in and we say, what is the best match in the cloud alternative? And this is based on, I believe, the EU regions, but then we go and look at inside the EU regions, what's the cheapest region to buy the capacity, and where can we get the most capacity for our money, given that we have some minimum requirements. And basically what we see is that in some cases, on-premise alternative is actually still cheaper than just going and doing.
Yeah, and basically in most cases, actually, yeah. it is. Yeah, on the Linux, which is what we publish here, it's a mixed picture when we look at. I think we have the Windows afterwards. No, we don't. But it's published in the report. The Windows part, it's a bit different picture, but typically what it says here is, yeah, in many cases it will become slightly more expensive if you move it to the cloud without optimizing.
Yeah, and you mentioned if you have with Windows, there's a really interesting thing here about just the operating system licenses, which if you don't use, for example, Azure Hybrid benefits, where if you own OS licenses yourself, then when you are leasing these licenses from the vendors, it really drives up the price quite significantly. And so if you have Windows, it only becomes even more important to make use of these different benefits and try to purchase it smartly.
So, message number 1 here is, when you move stuff to the cloud, make sure you optimize it in the cloud, because this is a one-to-one comparison. So we took the capacity in the on-prem scenario and basically ported it into the cloud without optimizing. You need to optimize. That's message number 1. In order for it not to become more expensive. Then there's this one. This is a new graph. I think, did you make it?
Yeah, I think I made this one. So basically this is for the archetype 3, which is just one of the configuration setups.
So this is basically just for everybody to be on board. So this is basically, we took one of these, number 3 in the middle.
Yeah.
And then we look at it over time.
Yeah, so we look at the cheapest alternative. It only shows the price of the cheapest vendor for this archetype for each quarter that we have published the report. So this is given that you each quarter go in and find the cheapest way to purchase this given your requirements across all 3 vendors and so on. How does it look? And what we see is that historically it has been AWS, which has been, for this exact archetype, has been the cheapest alternative. But then somewhere in around late 2020, the on-premise actually caught up again. And that's because you have had these declines still in the server prices. And then in the most recent quarters, you have some new servers and so on that has been introduced by Google, which actually led to them kind of taking over for this archetype. So this also kind of shows the internal competition between the vendors.
But this also is, in my opinion, a very, very interesting graph for all the vendors. Because what it says here is that if you are a vendor helping your client to purchase or providing, whether you're providing capacity or help the client purchase the capacity in the cloud, if you are providing actually what we call a hybrid ITO service, if you are a vendor here, then you would say, okay, if I'm to help the client the best way, what I would be doing is that in 2019 and the first 3 quarters of 2020, I would probably advise the client to put the capacity in the cloud. But at one point in Q4, I should be able to provide the capacity myself for the client cheaper than buying it in the cloud. Now, this is even providing the capacity at normal standard market price. Put to that the vendors in these situations probably will go in and look at the marginal cost of providing the capacity. So each vendor will have a number of VMs available in their capacity setup and might be able to offer the clients that capacity at a lower price than they would normally sell it at. So we believe that there's going to be a lot of arbitrage internally within the vendors in optimizing the client's load between hyperscalers and themselves, really. So moving capacity back and forth, of course not every day or every week or every quarter, but perhaps once a year to basically take count of where should we put the capacity and can we provide the capacity cheaper than the hyperscaler can. Because this graph shows that it's a very fluid market, that it changes from quarter to quarter, and that's basically also what you see if you follow in the report. If you follow these archetypes over time, they basically change.
Yeah, and it's also really, really difficult to keep track on because the public cloud alternatives, they constantly expand. So then they introduce new server types with different processors and all these kind of things that happen, and you have to keep an eye out for this.
And put to that, one thing that we'll get back to in June, the thing that we are just starting to understand, and that is the new server types will have slightly lower price, but more capacity. What does that mean? Well, it basically means that this is someone else doing capacity or performance benchmarking of the VMs in Azure, Google, and AWS. So they're calling Cockroach Labs. They're really they're a database provider. They sell a database, but then to basically help clients understand how much capacity they need for their database, they have a separate unit that does performance benchmarking of public cloud capacity. This is really interesting because what it shows here is basically that we have a different version, a version 4 and a version 5 of the same server in Azure. Now, version 5, in the red square, you have the version 4 and the version 5. And the version 5 has a performance index. It's called transaction per minute. Could be anything. It's like MIPS for VMs in the cloud. MIPS is the capacity, the performance indicator for mainframe, for those who are not aware of that. Okay, so basically what it says is that the count is 790 over 653. So it's an increase from 653 to 90, sorry, in basically how much horsepower do you get for actually a little less money when we're moving from one version to the other. Now, this means that if you have an application running on one VM, it will probably run on one VM in the future. And you'll just have a more powerful VM that you're not really using. But if you have an application running on 10 VMs, then you probably could do with like 8 VMs or something less in the future. So you can actually optimize also on the capacity based on increased performance. Now, this is getting more and more difficult. Moving things to the cloud and managing things in the cloud, the FinOps part of it is becoming more and more difficult. It's a more and more complex operation to undertake. And this is just adding yet another layer of complexity. And this is why we'll spend probably more than 1.5 hours on that on our next webcast in going through all the details there. And yes, you get a lot of new VM configurations over time in Azure. So that's what's happening there. So slightly more capacity, slightly lower price. And yeah, this one is really about I think you mentioned it briefly, that different regions have different prices. So that's another optimization lever that you have. Where do you put your capacity? And this one basically shows 3 different VMs that you can buy among the hundreds of different VMs you can buy, but then we're just taking 3. And then we say, okay, I know it's a little difficult to read, but what you have is each bar is a region. And what it shows is which is the most expensive region, which is the cheapest region. And the red is what is usually the most expensive region, and the greens are what is usually the cheapest regions to put your capacity in. But what you can see is that it's not consistent. You can see in the middle one, that is a VM that actually follows the average pattern, all the reds to the left, all the greens to the right. So those are individual regions. Norway is, as I think there's Norway West is typically the most expensive one. So why should I take Norway West? Well, if you're looking at carbon emission, it's also the one with the lowest carbon emission. So going back to the ESG question we had before, basically that could be the reason that you're actually going for Norway West. Could also because you are located in Norway West and you want low latency and so on. So there could be different reasons why you prefer that region. But as you can see to the left and to the right, yeah, there are exceptions where you have regions that are normal, the green regions that are normally far to the right, actually now in the middle. So it's not a consistent picture of what is cheapest. So that has to do with the composition of services, where's it cheapest to put those services. So this is just to say, yeah, cloud is becoming an increasing part of the capacity provided to clients. The vendors we're looking at is helping a lot of the clients managing that. So and the complexity of that just explodes right now. Mm. And we talked to a client yesterday. I had a team from the client around the table, and the finance guy. These guys had put a lot of capacity in the cloud, and the finance guy was the one looking most tired, I would say. He was a challenged guy because it is becoming less and less predictable And that was the beauty of ITO in the past. It was the most predictable part of your IT budget. It's not predictable anymore. Okay, so short recap on our recommendations to the customers. And then we have some recommendations to the vendors as well. Be aware of the movements in the upper half of the market. There's things changing right now that could be of interest to you. Be prepared for a price talk with your IT vendor. Drive the argument against short-term price increases. We believe that the market should sort this out in some way or the other. So if you're being met with short-term price increases, take the discussion. We have an article here with all the good arguments. Security should be a priority in 2023. I think that's basically running in an open door, but keep your eyes on the total cybersecurity risk profile, the total risk profile, and make sure that your setup and contract reflects it. Some of you out there are managing what we call critical infrastructure. You will be faced with a lot of new requirements in this area. And make sure that you have a contract that actually reflects that. And go to our article on security services. There are things that you should expect to be part of the standard service, and there are things that you need to buy on top. Carefully plan your cloud journey. Make sure you know how your contracts support that. Get your FinOps under control right now. And set aside resources to negotiate your SaaS agreements. In the future, a part of your capacity will basically disappear from your standard ITO contract or your in-house ITO setup, and it go into SaaS agreements. Make sure that you manage that in your SaaS agreements, that they actually allow you to take advantage of decline in capacity pricing. Consider your requirements for sustainability and carbon footprint. This is still, the cement is wet. We are still seeing this being defined right now. We are seeing a lot of new services, especially in the hybrid space, especially around cloud management and so on. Carefully evaluate your vendor service portfolio against what you think you'll need in the future. If you are moving 25% of your capacity in the cloud, you will need a lot of quite elaborate cloud management services. Make sure you have them either in your contract or that you have the good dialogue with your vendor on what kind of services they will be able to provide. One thing that keeps surprising us is how poor an overview most of our clients have of their capacity requirements over the coming 2 to 4 years. This is not easy. It means that you need to, as a CIO or sourcing manager or whatever, that you need to interview all your business stakeholders to understand how they're going to use your systems in the future and what kind of new systems you will put in place, and translate that into capacity requirements. You need to do this to make sure that your agreements basically fit those. And that new hybrid future requires new contract paradigms, and it basically forces you to revisit your contracts more frequently. Make sure that, the times where we entered an ITO agreement and put it in the drawer and basically it stayed there until it had to be renewed, those times are over. You need to make sure that you evergreen these contracts, not only for price, but also for the service portfolio and the services provided in the contract. Times, they are changing. To the vendors, our recommendation is basically the changes in the top of the market represents both threats and opportunities. Focus on building the right competences, focus on service automation and efficiency. In a market like this, with increased salaries, wages and energy prices and so on, internal efficiency and automation is key. The future is hybrid. Make sure that your service portfolio reflects that. Make sure that you have your cloud management and FinOps competences in order. Prepare for substantially increased security requirements. That's both a threat and an opportunity. It's a threat in terms of if your basic services cannot basically live up to the minimal requirements for IT security, it will become a problem to you. But security is also a marketplace of its own. So it's a segment in the market where you can make a lot of money. So yeah, threat and opportunity. The demand for a wide array of dedicated security services will go from basically being a differentiator to a hygiene factor. So can you provide the client with a SOC, for example, a security operations center? Well, for many clients, they might not buy that, but to have that as an option in the contract will probably be a requirement for many of the clients. Vendors should prepare for demands on carbon emission reporting. And last but not least, the DevOps, interfacing into agile development schemes at clients is an area that you should prepare for. All of these recommendations, all of the observations in the beginning, they're all being basically fleshed out in the report. So that was, I don't know, do you have more comments on pricing and everything, anything?
I don't know. I think the only thing that I'd add is that you made this really good point about the increased capacity in the cloud when the new generations are introduced, but this also applies to traditional ITO.
Yeah.
So when you have a large setup, maybe you have some kind of application running on a giant server. If you just keep replacing that server with the next one, because it has more capacity, then you end up with overcapacity over time.
That's true. Yeah, that's a very good point, and we've seen that.
Yeah, we see it really often, so it's just I just add that. Yeah.
Yeah, that's good, and it actually came a bit of a surprise to us because the significance and the magnitude of that is that if you have an outsourcing contract with a vendor, and that vendor put in a physical server or a number of VMs for your application like 10 years ago, and then you renewed the contract, and you had it price adjusted and so on, but you still have the same number of servers. Well, today those servers have been replaced by newer servers with higher capacity, and yeah, you will have overcapacity. So that is why looking at right-sizing your infrastructure is also extremely important. We didn't put it in here, but it is becoming an increasing part of actually optimizing your IT finances is to look at right-sizing. We hope that you enjoyed and had good use of today's presentation. So thank you.
Thank you.